Equity financing versus debt financing. What is equity financing? Equity financing is a type of funding that allows businesses to sell ownership stake in the company in exchange for capital. This can be done through private placement or an initial public offering. Equity financing can be a great way to raise capital for businesses, but it also comes with some risk. For example, if a business does not perform well, the value of the equity may decrease and investors may lose money. The main advantage of equity financing is that there is no obligation to repay the money acquired through it. Of course, the company's owners want it to be successful and provide the equity investors with a good return on their investment, but without required payments or interest charges. Equity financing places no additional financial burden on the company. Since there are no required monthly payments associated with equity financing, the company has more capital available to invest in growing the business. What is debt financing? Debt financing is a type of funding that allows businesses to borrow money in exchange for repayment with interest. This can be done through loans from banks, credit unions, or other financial institutions. Debt financing can be a great way to raise capital for businesses, but it also comes with some risk. For example, if a business does not perform well, the borrowers may have trouble repaying the loan and may default on debt. The advantages of debt financing are numerous. First, the lender has no control over your business. Once you pay the loan back, your relationship with the financer ends. Next, the interest you pay is tax deductible. And finally, it is easy to forecast expenses because loan payments do not fluctuate. The downside to debt financing is very real to anybody who has debt. That is a bet on your future ability to pay back on the loan. Equity financing versus debt financing. Companies primarily have two types of financing as an option: equity financing and debt financing. Most companies use a combination of debt and equity financing, but there are distinct advantages to both. Principal among them is that equity financing carries no repayment obligation and provides extra working capital that can be used to grow a business. Debt financing, on the other hand, does not require giving up a portion of ownership. Companies usually have a choice as to whether to seek debt or equity financing. The choice often depends upon which source of funding is most easily accessible for the company, its cash flow, and how important maintaining control of the company is to its principal owners. The debt-to-equity ratio shows how much of a company's financing is proportionately provided by debt and equity. Here are equity financing versus debt financing example. Company ABC is looking to expand its business by building new factories and purchasing new equipment. It determines that it needs to raise $50 million in capital to fund its growth. To obtain this capital, Company ABC decides it will do so through a combination of equity financing and debt financing. For the equity financing component, it sells a 15% equity stake in its business to a private investor in return for $20 million in capital. For the debt financing component, it obtains a business loan from a bank in the amount of $30 million with an interest rate of 3%. And the loan must be paid back in 3 years. There could be many different combinations with the above example that would result in different outcomes. For example, if Company ABC decides to raise capital with just equity financing, the owners would have to give up more ownership, reducing their share of profits and decision-making power. Conversely, if they decided to use only debt financing, their monthly expenses would be higher, leaving less cash on hand to use for other purposes as well as larger debt burden that it would have to pay back with interest. Businesses must determine which option or combination is the best for them. Is debt cheaper than equity? Depending on your business and how well it performs, debt can be cheaper than equity. But the opposite is also true. If your business turns no profit and you close, then in essence, your equity financing costs you nothing. If you take out a small business loan via debt financing and you turn no profit, you still need to pay back the loan plus interest. In this scenario, debt financing costs more. However, if your company sells for millions of dollars, the amount you pay shareholders could be much more than if you had kept the ownership and simply paid a loan. Each circumstance is different. Is debt financing or equity financing riskier? It depends. Debt financing can be riskier if you are not profitable, as there will be loan pressure from your lenders. However, equity financing can be risky. If your investors expect you to turn a healthy profit, which they often do, if they are unhappy, they could try and negotiate for cheaper equity or divest altogether. Conclusion. Debt and equity financing are ways that businesses acquire necessary funding. Which one you need depends on your business goals, tolerance for risk, and need for control. Many businesses in the startup stage will pursue equity financing, while those already established and those who have no problem with debt and possesses a strong credit score might pursue traditional debt financing types like small business loans. That would be all. Thank you for watching.